Are you trying to build a portfolio that will stand the test of time without spending nights burning the midnight oil researching individual stocks? Are you looking for a low maintenance way to get exposure to the market? Do you want a dollar cost average and just set it and forget it? I've got just the portfolio for you, and it's known as the 3-Fund Portfolio. Just a quick reminder that I'm not and NerdWallet Inc. aren't financial advisors. This is educational content by NerdWallet, and we aren't providing investment advice. Okay, so let's get right into it. What is a 3-Fund Portfolio? So this is made up of 3 different asset classes. We have US stocks, we have US bonds, and we have international stocks. They're going to be made up of 3 index funds or their equivalents. I have question marks here for each one because I want to show you those in a little bit here. I don't want to spoil it. And then also, the reason I like this approach or this portfolio so much is because it's a long-term investing solution. So instead of researching all these different stocks, looking at 10Ks and all these different forms, all these different press releases, all these different news headlines, this allows you to dollar cost average over the long term, knowing that you have a well built out diversified portfolio, and also it prevents FOMO. FOMO stands for fear of missing out. So when you hear certain headlines or certain stocks ripping, yes, you can still invest in those, but if you're looking for a long-term solution that's almost set it and forget it, the 3-Fund Portfolio checks all these boxes. Again, I'm not a financial advisor. I'm not telling you exactly what to buy, but we're going to get into the benefits of a 3-Fund portfolio and how to actually build it right now. So let's start with diversification. We're going to get exposure to literally 12,000 plus stocks. So the first fund I'm going to tell you about has over 3,700. The second one I'm going to tell you about has over 8,600. So you're getting a huge amount of exposure based on the 2 equity portions of this portfolio, the 2 stock portions of this portfolio. Number 2 are the low fees or the low expense ratio. So expense ratio is just a fancy term for fees. So typically, a financial advisor is going to take 1% of assets under management every year, and that's how they're compensated. With these 2 funds that I'm going to tell you about, you're going to have one that costs literally 97 basis points less. So it costs 0.03% versus 1%, and the other fund is 0.08% versus 1%. You're going to save a ton of money in fees over the life of this portfolio. And then finally, it's easy maintenance. What do I mean by easy maintenance? So we have easy rebalancing. It's easy to maintain and monitor this ratio, which I'm going to show you next. Remember, when we create this 3-fund portfolio, there's 3 different types or 3 different asset classes or positions. It's very easy to maintain each slice of that pie, which I'm going to show you exactly what these examples are and how much of your pie you can dedicate based on your age. Okay, so now is the big reveal. Let's talk about what actually goes into this 3-fund portfolio and some examples. So let's first talk about allocation. Okay, what you need to understand is if you look at your net worth, you need to look at it like a pie. So a typical rule of thumb historically for most financial advisors has either been the number 110 minus your age, or if you want to be a little bit more equities heavy, you can always use 120 minus your age. So for easy numbers, let's say you're 40 years old, you would take 110 minus 40, that gives you 70. That means 70% of your portfolio should be dedicated to equities or stocks, okay? If you want to make this a little bit easier, I could make this age 30, which I'll do right here. Say you're 30 years old. That means 80% of your portfolio is going to be in equities. So here's some examples. And you can adjust this by your age. You can adjust this by your risk tolerance. Again, not a financial advisor, just giving you some ideas. So we typically have 3 different types of allocations for a 3-fund portfolio. We have 80-20 equities to bonds, 33-33-34, 20-80 equities to bonds, right? And you can split this up however you want. So if you want to use the pie analogy, you can take these different funds that I'm going to show you, and you can just break up that pie, think of it like a pizza, and you can allocate different weights to your slices by percentage. So let's recap what's actually in this portfolio. We have US stocks, US bonds, and international stocks. This is what makes up the 3-fund portfolio. Now, what is an example of US stocks? So I'm going to use basically ETFs and mutual funds from Vanguard. So for US stocks, you can use the ETF VTI. But you can also use, Schwab equivalents, Fidelity equivalents. There's a million different ways to get exposure to these different types of assets. I'm just going to use VTI and keep it, one flavor all across the board. And remember, these are just examples, and that Vanguard is a monetizing partner with us here at NerdWallet Inc. However, they did not have any input or review of this video. Mention of Vanguard is strictly for educational purposes. And real quick, everybody, I personally own shares of VTI, which is an ETF provided by Vanguard. I want to show you this pie analogy. So again, US stocks are VTI. If you want the mutual fund equivalent, you can use VT Sax, VT like sax, like saxophone. For US bonds, you can use BND, or you can use VBTLX for the mutual fund equivalent. Or for international stocks, you can use VXUS for the ETF, or the mutual fund equivalent for that would be VTIAX. So let's say we go with an 80-20 portfolio, for example. So in this 80-20 portfolio, you're wondering to yourself, hey, Marko, there's only two things here. There's 80 and 20. What about the third fund? So remember, we're breaking this down into equities, which is stocks, that makes up the 80%, and then the 20% would be bonds. So an example like this, you would actually break it down to 64, 20, 16. So what is the 64? The 64 is going to be the US stock equivalent. So in this case, we're going to use VTI. The 16 is going to be the VXUS, the international portion of this portfolio. And sorry, I know you probably can't read that. And then the 20, which this looks more like, sorry, this is more like 50. 1 second. I'm not an architect or an engineer. Give me 1 second. So here's 64. Here's 16. The 16% is going to be the international exposure, VXUS. So 64 plus 16 is 80. And then 20 is going to be BND. That's going to be the bond portion of the portfolio. So the reason I talked about that this is easy to maintain is because if any of these weights get out of whack, let's say you get to like 80% VTI, 5% VXUS, and then the remaining 15% are bonds, you can easily choose to stop investing in VTI, beef up the portion that's underweight, and then you can just rebalance accordingly. So you can always maintain that ratio if that's what you want to do. So this is super easy to implement, and what I mean by easy is that all you need to do is really pay attention to your weights and the 3 asset classes, and you can get exposure to easily create this 3-fund portfolio. Okay, so I typically like to end my videos with a My Thoughts portion just to give you a candid overview. So again, the reason I like the 3-fund portfolio is because less is more. A lot of people overthink investing, which actually prevents them from number 3, which is easy to start. So what I mean by simple and less is more is that you're only paying attention to 3 funds. Once you understand which 3 funds you want to invest in, it's very simple to set up dollar cost averaging. Take a little bit of your budget or your paycheck every week, every month, every day, depends on how often you want to invest, and you can just dollar cost average over time. So typically with dollar cost averaging, if the market goes up and to the right over time, which it has, you're going to end up somewhere in the middle. You'll be buying the lows, you'll be buying the highs, you'll be buying the chop or the sideways movement. So very easy to maintain. Number 2, I wanted to highlight this. In my research at the time of this recording, BND is actually down 5.29% since its inception, okay? So if you're looking for something that kind of eliminates bonds or actually is a little bit less bond heavy, you may want to check out the 2-fund portfolio video that I'm going to be coming out with on this channel. And then also number 3 is that it's easy to start, okay? So when you start, it's easy to encourage yourself and to get that confidence saying like, hey, this is not going to be a 1-week endeavor. It's not going to be a 1-month endeavor. This is going to be a multi-decade endeavor as long as there aren't any major changes in the market systemically. So this is going to continue. It's actually going to encourage continual investing, and it's going to help you grow your portfolio over time. Again, I'm not a financial advisor, but this is one of the easiest portfolios to start and maintain. So hopefully now you have a better understanding of what a 3-fund portfolio is. I encourage you all to check this out. Check out the performance. You can back test it using a website like portfoliovisualizer.com. You can check out our resources at NerdWallet. But most importantly, if you got value out of this video, please like, comment, and subscribe. Share the video with a friend, and happy investing.